Let's stick with volatility now. The VIX losing some of its gains, gyrating quite a bit today, though still as volatility takes hold in the markets. The index still at its highest since 2011. Joining us from CME is Bob Iaccino, Chief Market Strategist with Path Trading Partners. Bob, how are you feeling today? Is there a little bit of nervousness down there? Are you quite happy that the VIX is ramping up again?
No, I don't think nervousness is the right word, Vonnie. I think that a lot of this, for people like myself who have been around about 26 years, this has been expected and has taken quite a while. You know, when you look back at sort of the history of the VIX, pre-2014, the average on the VIX was about 20. The mean was about 17. And if you remember back from statistics classes, the mode, which is the level it visits most often, was around 13. So as we've been traveling over this last year and a half, 2 years, at this 10 level as the mean reversion tends to ramp up. I mean, it's a mean reversion index. It's not a price action index where you expect it to rally to 100 and then possibly fall to 0. That's not what happens with the VIX. So the mean is adjusting here. It's the kind of thing similar to what's happening with Bitcoin, where we've expected this to happen. It probably took longer than people thought.
Yeah, so, I mean, the mean is typically, what, about 20? Do you anticipate that the VIX will return to that level as soon as these products sort of shake out or off the market or investors are out of them? Or will the quants and the risk parity hedge funds, the CTAs, will they have huge effects on this index over the next week, month, 6 months?
I think it's going to take a while to shake out. You know, again, with the VIX, what we've generally seen from clients and people we talk to is that the short VIX trade for us, the short vol trade, has been an overlay strategy more so than a core position. So you've got your core position hurting on the long onlys and then the overlay hurting as well. That's how a lot of these funds outperform the index when they're benchmarked to it, is they go into something like short vol. And that's been the trade lately. So we're going to see quite a bit of underperformance. You're going to see redemptions. But again, this is normalization when you've been around a while. You've seen this before. This is something that I actually have. One of my partners is in South America. He's 27 years old, and yesterday he was acting like it was a once-in-a-lifetime event. The percentage change really was close to a once-in-a-lifetime event. But these kind of events happen. They take the speculation out. Fundamentals of the market are still really strong.
Yeah, just quickly, Bob, what are people down at the CME doing today? Where is the trading happening?
We're actually seeing quite low volumes right now. We're seeing quite a bit go into the 10-year note options. I'm seeing a ton of movement in there. We're finally getting a little bit of a flight to quality bid in the treasuries. I don't necessarily think that's going to last either, but we're seeing most of the occupation, most of the play go into options, not into outrights. Outrights volumes are very low.
Bob Iaccino, what a pleasure. Chief Market Strategist with Path Trading Partners, giving us a check there on how things are happening at the Chicago CME. All right.